The way that we have looked at the course so far is in the earliest chapters we talked about recruiting people and training them. We've then talked about putting them into teams with a manager. And obviously in the last chapter we talked about getting them to work harder. So in other words, we started with an individual and we've gradually worked it out, so we're talking about a team. What we're now going to talk about is we're going to start talking about various departments. The main one that we're going to talk about is the accounting department, the finance department, obviously because that's of interest to you. But we will also talk about some other departments such as marketing a little bit later on in this particular chapter. So as I say, we started with one person, gradually widening it out into a team, now we're widening it out to an entire department. So what exactly goes on as far as accounting is concerned? What is the role of accounting? What's the role of finance? What kind of financial systems do we have? That's going to become particularly important when you start talking about auditing later on in your studies. How does accounting mix with other departments? And as I say, we're going to have a little bit on marketing. A lot of the stuff that we're doing in this chapter is going to be used as a basis for other papers later on. I've already said that the financial systems are going to lead into the auditing papers, so F8 and P7. The marketing part is going to lead into P3, which is one of the other papers that I teach. So you're going to see a lot of this stuff again. The idea is it's trying to give you some kind of context of what it is that you actually do as far as the organisation is concerned. We will also talk a little bit about financial accounting, which is what you're doing in F3, and management accounting, which is what you're doing in F2. So we'll talk about how the three of them tie together. So, first of all then, what exactly is the role of the accounting function? Now, if I ask you guys that, what's the role of the accounting function? Most students will say it's to prepare the P&L and to prepare the balance sheet. I know those are the old-fashioned names for them because I'm old-fashioned. The new names, preparing the income and expenditure statement and preparing the summary of the financial position of the organisation. But we're talking about the same thing. Now, that's what most students will say. But the trouble is, how often do you prepare them? Well, presumably you only do them once a year, don't you? So what are you going to be doing for the rest of the year? So yes, preparing things like the end-of-year financial statements are important. But finance departments do a lot of other things on top of that. So, for example, one of the key things that you will see in F8, P1 and P7 is they establish and then implement financial procedures. We will talk about that a little bit later in this chapter when we start talking about systems. It's things like what has to happen before you pay an invoice. So, establishing and implementing them, monitoring performance, knowing how well the organisation is doing. That, as I say, leads on to P3. It also leads on to P5, the two papers that I teach. So that's going to be a very big deal. So we will see a little bit later, and in some of the other papers, how all these things fit together. Now, in the UK, at the moment, so in 2008, there are various rules that govern what we actually have to do. This is obviously just a memory test as far as the exam is concerned, but you do need to know these rules. So, in the UK, you have to present your accounts to a particular part of the government. In our case, in the UK, Companies House. You also have to make sure that your accounts are submitted to Companies House for tax purposes. So if there is any profits, there may be some tax. You will look at that when you start looking at F7. You have to keep your records for a certain length of time. A standard length of time, again in the UK, is 7 years. So if you have a company, you've got to keep all your records going back for at least 7 years. Now, regulators, there are certain industries, again in the UK, because obviously it's a UK exam, so this is going to be tested more often. There are certain industries where not only do you have to present your financial statements, but you also have to prove you've done things in a particular way. So, for example, telecommunications industries. in the UK, things like mobile phone companies, are governed by certain regulators. The train network, regulators will come along and say, you have to do things in a certain way. So there are various industries that have extra rules put on top. Electricity generation is another example. So you have to make sure if you are in those industries that you follow those particular rules. Finally, it says you may also have to submit a register of directors, a register of shareholders. Now, to be honest, we're not going to go into any of these in any great depth. You will see that when you do paper F4, when it talks about law. So that's going to be some of the company law stuff that you do. So we're trying to put in context what the accounts department does. The accounts department, one of the things they do is they make sure that we don't break the law by filing all the particular bits of paper, by sending the particular bits of paper off to the government, to the tax offices, and to any regulators that we have. So in other papers, you will learn what those bits of paper are, in F4, in F7, etc. But in this paper, we're just simply saying, you've got to make sure it happens. So, what kind of requirements do we have? We have to make sure when we prepare our accounts, this should look familiar to you from paper F3, because there will be various accounting standards, IFRSs, that you have looked at, or IASs that you have looked at. So when you are doing depreciation in F3, you do it in a particular way. There is a standard that is used, and you must make sure you follow it. Generally accepted best practice. There might be particular situations where you are asked to use your judgment. For example, the provisions for bads and doubtful debts. So there may be guidelines, and you should follow those. It says they're information of sufficient quality and quantity. So again, provisions for doubtful debts is quite a good example. How did we decide that we were going to say some debts were going to be written off and some debts we thought we would get? So if your company has to prove that a debtor is likely to pay, how would they do it? So in other words, you have got a receivable. You've decided that you're going to leave it as a receivable in the books. You're not going to write it off. How can you justify that you've done the right thing? The information will have to be good enough, and there'll have to be enough of it so that you can say it is reasonable to expect we will collect the money. Underneath that, it says being free from material misstatement. Now again, this is something you'll look at in F8. A misstatement is something that's wrong. Now, in F3, it would be nice to think that our accounts will always be correct, but they won't be. Accounts will always be wrong because you're always making a judgment over who's going to pay you. Yeah, there will be some people you think are going to pay you and don't. Some people you're not expect to get payment from and you do. So your accounts will always be slightly wrong. So they'll always be misstated. Material means it makes a big difference. So the authorities don't mind your accounts being very slightly wrong because, as I say, it's a judgment. What they do care about is if there is a big misunderstanding, a big misstatement in your accounts. Now, who is responsible for making sure that the financial statements meet all of those things? Well, it is the directors of the company, the chief executive officer, the managing director. It's not the job of the finance director only. Notice what it says underneath. Usually, the finance department will make sure that the accounts are correct, or as much as they can be. The finance department will make sure they do all these bits of paper. But if anything goes wrong, it is the director's fault. They are the ones that will be held responsible. So they need to make sure it happens. Even if all they do is say to the finance director every month, are we on course to actually make sure everything is going to be done? So, notice it says here, you may, when you're doing these, you may even need some outside help. Again, we will talk about that, or you guys rather will talk about that when you get to do paper F8. You'll need to keep a record of all your transactions. One of the things that we will talk about later on in this course is all the different systems that you need inside an organisation, all the different bits of paper that you need in order to record something. One of the most fundamental ones is how do you make sure that you've got details of everything you've sold? How do you make sure you've got details of everything you've purchased? Because if you don't keep a record of everything, then how are you going to know the correct sales and purchases figure? In paper F3, obviously I'm assuming that you've started paper F3. In paper F3, you've probably already talked about sales on credit and sales for cash. How do you know that all the sales for cash were recorded? How do you know that somebody didn't forget to write something down? So you made a sale, but there is no paper record of it. When you actually come to prepare your accounts will be wrong because they won't have that sale in it. So somehow we need to make sure that everything is recorded. And again, that's going to become a very big deal when you look at auditing in paper F8. So if you don't comply, if you don't make sure you meet all those regulations, there could be some very serious consequences, such as going to prison. Failure to keep your accounting records is a criminal offence. It's going to be punishable by a fine, and if it's serious, potentially by a jail sentence. Similarly, if your accounts do not show a true and fair view, again, we could have exactly the same issues. Underneath that, if your tax records aren't complete, then the tax authorities could claim that you are deliberately trying to avoid paying tax, and that is also a criminal offence. Audit reports being qualified, that may not mean an awful lot at the moment, but that will become significant when you start talking about auditing. If a company has its audit report qualified, in effect, what is happening is an independent team of people, the auditors, look at the company's accounts and say you can't trust them. Now, what's going to happen then to potential investors if they don't know how good the company actually is? So all of these are very significant. And finally, business failure. If we have not kept a record of all the people who owe us money, then what happens when they don't pay? We don't know who they are. We can't track them down. We will go out of business because we won't be able to track down all the people who owe us. So all the consequences are actually extremely serious. So when we're talking about doing paper F3, particularly, if you don't do the things that paper F3 says, potentially you're going out of business. It's a very important thing to do. Okay then, in paper F3, you have been talking about accounting standards. You will already have talked about some of them. Where do they come from? In the exam and in the course, you just get told them. But in real life, there is a process that they go through. So first of all, the International Accounting Standards Board. And you can see there, they come up with international financial reporting standards. Now, what will happen is that the International Accounting Standards Board will look at things that they think are of interest in accountancy. Now, the thing is, accountancy changes, I wouldn't say all the time, but things do become issues. Some of the things that have been looked at recently and are being looked at the moment include things like share option schemes. How do you account for those in your financial statements? Because obviously they haven't actually been given to people yet. Share options are something you will get in the future. They haven't actually been given to people yet, but they're going to be. So are they a liability? And if so, how much should you put them in your statements for? Another one that I have read that is going to be having a financial standard on it at some point is things like loyalty schemes. Some of you may know that in a number of countries, big companies operate what they call loyalty schemes. In other words, I go to my local supermarket. Every time I get there and I spend some money, I get some loyalty points. After a certain length of time, when I've built up enough loyalty points, I can exchange those for products from this supermarket. So I can go along and say, here is £10 worth of my shopping that I am actually not going to physically pay for. I'm going to use my loyalty points. Great. So is that something that goes in the liabilities? Because they owe me something in the future. Now again, this is the sort of area that they will look at. For some companies, that may be a tiny little amount, but for lots of companies, airlines, supermarkets, that could be a very significant amount of money of people who could go to their shops and take goods and not actually physically pay for them, use these loyalty points instead. Airlines, my wife and I have now built up enough air miles with the airline we tend to travel for. We have got 4 round-trip first-class tickets to anywhere in the world. That's what we've actually built up. We haven't used them yet. Now, they are going to be worth, in today's prices, that's worth something like £4,000 or £5,000. Should that appear in the company's financial statements as a liability? Because at the moment it doesn't. So the idea is things come along and the accountancy profession says we need to agree on how everybody's going to treat them. And that's where the International Accounting Standards Board get involved. So, the kind of things that they do, they will draw up a draft proposal. Let us look at loyalty schemes. They will put together a working group, and the working group will come up with some suggestions. They will then have what they call a discussion document. So the idea is that they will publish, this is what we think, this is our initial thoughts on the idea. We think we should look at loyalty schemes and treat them like this in the accounts. There will be public comments. So people will write in and say, that seems good or that seems bad. This bit won't work because. Now, obviously, if you're talking about something like loyalty schemes, there'll be a number of companies that will be affected quite a lot if this comes in. You would expect them to write in and make some kind of comment. There will then be what's called an exposure draft. And an exposure draft is almost like a practice financial reporting standard. It's not compulsory, but people can use it if they want to. Now, you may well have companies that think, we might as well adopt this now. And often they will then find practical issues with using this particular exposure draft. So nobody had thought of this. When we actually try it, it works like that. So an exposure draft is not necessarily compulsory. They will see how it works, they'll get some more feedback, and then if it does work, they will then issue an IFRS. And, for example, in the UK, companies are then bound to use it. So they then have to follow it. So it's quite a long, complicated, drawn-out process. It will take years to get through. And it's to make sure that the accountancy profession is trying to keep up to date with the issues that are affecting it. Now, accounting has obviously been around for a long time. It's been around for getting on for 600 years now. It was basically developed back in Venice in the 15th century. And the idea was it was invented by merchants doing trading in Venice so that they could simply keep a record of who owed them money. That was all. So the whole double-entry bookkeeping system that you do in F3 is, as I say, round about 500 years old. And the idea is that it basically hasn't really changed. Okay, it's got more complicated, but the fundamentals of it are always the same. There is a debit and there is a credit, and that's all that it does. Everything that you do in later exam papers, when you do, for example, paper F7, when you do, for example, P2, it's still just basically debits and credits. It's just getting them more and more complicated. So, initially, it was for one person. One person ran a business, and it was simply to keep track of who they owed money to and who owed money to them. As companies started becoming common, you then started having to do accounting because obviously you then had to share some profits out. So you had to know what those profits were. So things became more complicated. It also, as businesses became more complicated, you needed to have one person who kept track of all the money. So again, when Pacioli, the guy that came up with this, started, one person, it's my money, all I'm doing is writing it down so I don't forget it. As you start getting a company, you might have 10 or 15 people in the company, one person has to keep track of the money. You then had, getting on towards the sort of 18th, 19th century, you have what's called the separation of ownership. And the separation of ownership simply means the people who own the company, the shareholders, are not the same as the people who run the company, which is the directors. Now, I own shares in some companies, not many, but I own shares in a few companies. I am an owner, but I don't run the business. In fact, to be honest with you, I've never met the people who run the business in any of the companies that I have shares in. So the idea is separation of ownership. Owners who've put the money in, shareholders, directors who make the decisions. They are making decisions for me. So it's important to keep accounting records so that I know how well or badly they are doing. So that's one of the most important reasons why financial accounting is governed by the law. Because otherwise, if it wasn't governed by the law, the people who run the company could simply say, well, we're not going to tell you anything. So they are forced by law, if they take my money, they must tell me what they're doing with it. They must give me these financial statements at the end of the year. So, accounting standards, you can see there, were developed to assist comparisons. Before the days of accounting standards, you could do whatever you like. So we're going back 100 years, I would be interested in buying some shares in 2 different manufacturing companies, and I was trying to decide which one was best. One company depreciated its machinery, and the other company didn't. There were no rules that said it had to, so the second company has no depreciation at all. Now, of course, I can't compare those 2 companies because they're not treating their records in the same way. And the idea behind accounting standards was to try and force them to do things the same way. So me, as a shareholder, I could work out who was good and who was not so good. Now, obviously, I've been an accountant for a number of years, more than I'd like to say. But when I trained as an accountant, the accounting standards were UK standards. So each country had developed their own set. Now that you guys are studying, we have international ones where a lot of countries use the same ones. It's exactly the same reason. Just as UK standards came about so you could compare UK companies, international standards have come about so that we can compare international companies. So it's all to do with comparison. Everybody does things the same way so that I can compare companies. We will talk later on in the course about the rise of computer systems and how important they have been. But please remember, even if we're talking about computer systems, we are still simply talking about debits and credits. It's just they can get more complicated, that's all, but it's still just basically debits and credits. And the final bit we've got there, accountants providing assistance. Gone are the days when to be an accountant you simply had to do debits and credits. Accountants are now seen as vital to the success of an organisation. Now that means, I'm afraid, that as you get further through your ACCA studies, you will start looking at things like paper P3, another one that I teach, the one that I do the videos for. And if you're looking at paper P3, the idea is simply to say, how can we make a company better? How can we run it better? Forget debits and credits. This is about running successful companies. Accountants have become very, very influential in this. There's a study that was being done a couple of years ago. Out of the 100 biggest companies in the UK, around about 80 of them were run by people that at one point or another had worked in the finance department. So accountants are very, very powerful, and I'm afraid if you want to be successful at the ACCA, you're going to have to develop a lot of other skills rather than just being able to do double entry. But if you can develop them, it's obviously a very good career path. So what's the difference then between financial accounting and management accounting? In other words, what's the difference between paper F2 and paper F3? So management accounting and financial accounting. Let's start with financial accounting, paper F3. Financial accounting is used mainly by external users, shareholders. It's obviously going to be used internally as well. People are going to want to know how much profit we're making, but it's really for the external users. That's why the financial statements are governed by these accounting standards and by the Companies Act to make sure they're all being done in a similar way so they can all be compared. Final bit we've got down there, they are looking backwards. When you are talking about F3, you are pretty much always talking about things which have already happened. Now, one of the things that makes, I think, F3, it's not easy. I'm not going to lie to you and say that F3 is easy, because it isn't. But one of the things that makes it easier is the fact that because you're always looking backwards and you're always following standards, there is a set way to do most things. Any of you that have been doing any F3 will know there are certain topics where you always do things the same way. And so to a certain extent, financial accounting is about doing those things accurately, because it's always looking at things that have happened. F2, on the other hand, management accounting, which I am interested in because it leads up to P5, which again is one of the ones that I teach. F2 is all about management accounting, which is for planning what we're going to be doing in the future. So planning, it's also talking about control. So planning, budgets, control, variances. It looks backwards to look at what we have done with variances, but it also looks forwards to look at what we are going to do next. And by the time you get to P5, if any of you decide to do that, looking forwards is a very, very big deal. We need to plan ahead to run the business and make decisions about what to do next. Regulation, there isn't any. Because it's internal, you can do whatever you like. And that's one of the reasons a lot of students find management accounting harder, because there aren't the same kind of rules that there are in financial accounting. Financial accounting, you do your depreciation like this. In management accounting, there aren't always rules. Again, by the time you get to P5 that I do, there aren't very many rules at all, which in one way is easy, because it means you can make the rules up as you go along. On the other hand, sometimes it's hard because you haven't got anything you can rely on that you've just learned. But they are both roles that accountants have, and they are very, very different. And it's just important that we recognise the difference between the two of them. Now, within the accounting department, there are some specialist bits, some specialist things that we will be looking at. For example, one of the departments will be the Treasury. Now, you don't get this in all companies. You tend to only get this in large companies, particularly where there is a group of companies, and even more particularly where perhaps that they are based in different countries. So a multinational would have these. The idea behind Treasury is looking at things like cash management. It seems completely and utterly pointless to have one group of companies, or one company in a group, that's got an overdraft, and to have another company in the group that's got some money in the bank. Because obviously, the one that's got the money in the bank is earning some interest, but it won't be very much. The one that's borrowing the money is probably paying quite a lot of interest. It would be exactly the same as myself and my wife having £10,000 in the bank and me borrowing £10,000 from the bank. That's completely pointless. So one of the things the Treasury Department will do is they will say which companies in our group, so remember a group of companies are all owned by the same people, which companies in our group have money, which companies in our group need money, and the ones that have it, in effect, lend it to the ones that don't have it, because that's a better deal than going to a bank and borrowing it from them. So cash management is a big deal. Financing. Again, big companies will need to borrow money. So the Treasury will look at what's the best source of that money. Can some of it be done internally? Again, have we got one company that's got a lot of money anyway? You might also look at, here is one company that needs money, here's another company that needs money, here's a third company that needs money. They're all owned by the same people. So rather than having each of them take out a loan on their own, which might be expensive, let's put them all together and take out a bigger loan, and hopefully we'll be able to do it cheaper. So it's trying to reduce the costs of things. The other couple of things they look at, foreign currency. Again, we've got an American company as part of our group, and we've got a French company as part of our group. There may well be reasons why they both need dollars and they both need euros. So maybe what we could do is try and do something so they don't have to keep going to the banks and getting the money, because it would be cheaper. Final one we've got there, tax. Can we try and make sure that we don't pay any more tax than we need to? We are not saying try and evade tax, because you're not allowed to. But there's nothing wrong with trying to reduce the amount of tax that you pay. And that's one of the issues that we look at when we do P5, when we talk about something called transfer pricing. So the Treasury function is basically trying to coordinate the work of lots of different parts of a company or different companies in a group to try and make sure we don't spend more money than we need to. Taxation. And again, taxation is going to be something that the Accounts Department look at. We've got here just 3 different definitions. We've got tax mitigation, tax avoidance, tax evasion. Tax mitigation is a fancy way for saying, can we offset some of our tax? Now, I am not a tax expert by any stretch of the imagination. All the tax that I ever learned, I forgot as soon as I walked out of the exam. And I'm afraid you will come across this when you do paper F7. But the idea behind tax mitigation is to say things like, we have one company in our group that makes losses, we have one company in our group that makes profits. You can offset the losses against the profits so that you don't have to pay too much tax. That is perfectly fine. You just need to make sure that you do it. And that's one of the things you'll talk about with corporation tax. Tax avoidance, again, perfectly understandable, making sure you don't spend too much in tax than you have to. Tax evasion, on the other hand, as I said a few minutes ago, that one is illegal. So that's trying allowed to, but not doing anything which is actually illegal. So there are a lot of different things that the Accounts Department does. As I say, it's not just double entry, it's not just debits and credits. Now, one of the biggest things that you guys will get involved with when you are working in an actual company, assuming you're not already, but when you guys are working in a company, is you'll be looking at what's called financial systems. This is a big deal as far as paper F8, paper P1, paper P7 are concerned. And what we mean by this is it's the pieces of paper that you record things on so that you know you are not spending money that you're not supposed to. Now let's just start. I won't do all of these, but let's just start, for example, with payroll. Payroll, you need to make sure that you are paying people for the hours that they have worked and no more than that. So you're not underpaying them, because obviously the worker would get upset, understandably, and you're not overpaying them, because then the company's losing money. So the first thing that you would need to do is you would somehow need to record the hours that people have actually worked. Maybe you have a timesheet. Maybe you have what's called a clock card. So when people arrive at work, they put a card that reads the time when they arrive. When they leave, they put another card in and it records the time when they leave. But somehow there ought to be some kind of record of how many hours you are working. There should be some way of working out overtime. So how much overtime was there? You then need to check that you get the relevant rates of pay. How much do we pay people for working in their normal hours, and how much do we pay people if they're working in overtime? We can then calculate what the pay is. So the number of hours that you do at ordinary rate, the number of hours you do at overtime rate. Now, that's the bit, to be honest. This comes up in F2. So, for example, in F2, you have to talk about how much money people earn. But when we do that, the exam question will say, this particular person worked 50 hours, that's 10 hours overtime, and here's the rates of pay. Well, in a company, we need to check all those things. We need to check that they did work 50 hours. We need to check that 10 hours were overtime. We need to check what the rate of pay was. We need to check all those things so we don't pay somebody too much money. We then calculate the deductions. Deductions are things like how much gets taken off for tax. So there'll be standard things that in the UK are taken away before you get paid. One of the systems that we will have to have is to make sure that that money gets handed over to the government. So if we have deducted £100 from somebody's salary, in order to pay their tax. So they earn 1,000, we take 100 off to pay the tax, we must pay the worker the remaining 900, and we must pay the taxman that 100 that we deducted for tax. You'll need to have a system to make sure you do that. So it's all about making sure that we do things correctly. Similarly, and I think this one is a very good example for those of you that are doing F3. In F3, you will simply be told, we sold something on credit. So we make a sale, we have a receivable. Later on, the customer pays us. We get rid of the receivable and we put the money into the cash account instead. So we will debit the bank and we'll credit the receivable. But in real life, how do we make sure all those things are happened? In F3, you don't worry about most of this, but in real life, this is incredibly important. First of all, how do you know there's a sale at all? Well, you receive an order. A customer phones you up and says, I want to buy something. A customer orders something for a website. A customer writes to you and says, I want to buy this. The customer does something and you receive that order. You then process it. You look, for example, to see things like, are we going to give this customer the stuff? Do we have it? Do we have it in inventory? So we process the order. We generate a piece of paper that says, right, we've now got a customer. You dispatch the order. There may well be a piece of paper that now needs to be produced to say that this part of the order has gone and we can invoice the company for it, invoice the customer for it. For example, what happens if the customer phones up and says, I want two things. One of them is in the inventory at the moment and one isn't. What do? Perhaps what we do is we wait for both of them to be in the inventory, send them both together and send an invoice. But that might not be what the customer wants. Maybe they want one of them very quickly. So now what we have to do then is take the customer's single order. We've now got two different deliveries. So one goes now and one's going to go in 3 weeks' time. What do we do with those deliveries? We dispatch the goods. Do we have an invoice for each one separately? Or do we wait till they've both gone and invoice them together? I don't know the answer, but these are the kind of questions that a company has to answer. They have to have a system to make sure they do this, because otherwise they might send people something and never invoice them, or they might be invoicing them for things that they haven't received yet. Either way, we're going to have a problem. So you need to have some way of having a system. We raise an invoice. Right, we've now got a sale and we've now got a receivable. We record that in the accounts and then hopefully at some point the payment is received. So as I say, we'll be able to credit that receivable and debit the bank. One of the things we'll look at in a minute or two is how do we make sure that we get all the money from our customers. Now again, in Paper F3, you don't tend to bother about all of that stuff. In Paper F3, you simply tend to say, there was an order which we have now put in the account. You tend to start with this bit. But in real life, there's quite a number of stages that you go through before you even get to that stage. Similarly, in F3, you will simply say, we bought something, we purchased something for cash, or we purchased it on credit. But in real life, who is allowed to buy things in the first place? Who is allowed to order anything? Why are they allowed to order it? So if I want to buy something for the company, am I allowed to go out and buy it? If so, how much am I allowed to spend? Am I allowed to spend £10 on my own? Am I allowed to spend up to £100 on my own? What happens if what I want to buy costs £500? Do I have to ask somebody else? So who is actually allowed to order things? That's a very big deal in lots of companies, because otherwise you'd have people going around ordering things that perhaps the company didn't need. We then order them. We then get the goods being delivered to us. So the goods are received. That usually generates a piece of paper. There will be what's called a goods received note. We then receive the invoice, stick it in our accounts. We have got a purchase and we've probably got a payable, and at some point we're going to make the payment. And at that point, obviously, we debit the payable and we credit a bank account. Now, the thing we need to be careful is the invoice that's recorded. Should we pay it or not? Well, you should only pay it, obviously, if you've received an invoice, if you have received goods. So we're not going to pay for something we haven't received yet. And the other thing, which I know sounds a bit peculiar, but happens in real life occasionally, what happens, we ought to just check that we've actually ordered the things in the first place. There is a chance that we order something and we get delivered something different that we didn't order, something more expensive than we originally ordered. So we need to question why we have got it. So before we actually make a payment, we should check that A, we've got an invoice, B, we've received the goods, and C, that those goods are what we actually ordered in the first place. If one of those bits of paper is missing, then we're not going to pay the invoice. So again, I hope you can see that it's very important that we have all these pieces of paper. Otherwise, we will end up paying for things that we never received, paying for things that we never actually ordered. Over the page, credit control. Credit control is all about how much money will we allow our debtors, our receivables, to actually owe us. So how much credit will we give customers? So again, in F3, you have talked about somebody buys something on credit. Well, why did we allow them to do that? Why didn't we make them pay cash? So why did we say, you don't have to pay for it now, you can pay for it later? We have to receive the order, as we did before. We then have to do some kind of credit check. We will perhaps ask a specialist company what they know about this organisation. Have they been around for a while? Do they tend to pay their bills on time? We will do what's called a credit check. If we are not happy with the results, then we will go back to the customer and say, I'm sorry, you've got to pay cash. If we are happy with the results, we will go back to the customer and we will say, fine, here are your goods, pay us in 1 month, 2 months, 3 months' time. If it's a new customer, we will need to set up, didn't mean to do that. If it's a new customer, we will need to set up something in the receivables ledger. So if you remember, when you're talking about sales, you have to note not just that we've got sales, but you have to note who it was sold to, so that we know which customers to expect the money from. So if it's a new customer, we'll have to set up an account to do that. We then will send them the goods and invoice them. What happens if they pay when we're expecting? Great. Now in F3, that's usually what happens. They pay on time and then we do the double entry. We take it out of the receivables ledger, we put it into cash. Well, what happens if they don't pay? We need to think what we're going to do next. Are we going to phone them up and say, do you remember you were supposed to pay us? So, presumably fairly friendly. What happens if they don't respond to that? Do we then send them a letter? You were supposed to pay us, we've telephoned you, we haven't heard anything yet. Are you going to pay us? And if so, when? What happens if that doesn't work? Do we try and take somebody to court to try and receive the money back? Maybe we do. Maybe we don't. If we don't get the money back, then we will need to write off that debt. So that's where your bad debt provision comes from in F3. But notice there's been quite a lot of things that have gone on in the middle. In F3, you simply say somebody's not going to pay. In real life, you don't accept that. You try and do everything you can to get them to pay before you finally write that debt off. You don't want to be writing off debts all the time, because otherwise you won't get any money. So it's all to do with, all these systems are all to do with the way that we do things. Now, in paper F3, they would probably say to you, here are the stages, put them in the right order. So they'll do something like they will have the invoice is sent, and then underneath that will say the goods are dispatched, and underneath that will say the order is received. And obviously those three are in completely the wrong order. So it will probably have, here are the steps, please put them into the correct order. So just think to yourself, what's the first thing that's got to happen? Somebody from the outside world has to contact us if it's a customer. Then we would send them the stuff, then we would send them an invoice, then we would hopefully get them to pay. So hopefully we won't have too much of a problem with that. Now, there are other financial systems that we just need to be aware of very briefly in paper F1. So financial systems, what we're talking about here is we're talking about how do we make sure that all of the cash that we receive in our business has ended up in the bank. So if customers pay by cash, how do we know that all of that is recorded? Because obviously what could happen is that if I am working in a shop and somebody pays me cash, I could put the cash in my pocket and never record the sale. The company wouldn't know that that had happened. The company would end up not having as much profit as they would expect. So there's got to be something to either prevent me doing that or make it very difficult for me to do that. Now, that is very important. If it is your business, if I work for you and perhaps I'm the only employee, I am stealing from you. So obviously, you want to have a way that stops me doing that in the first place. If it's a big organisation, I'm stealing from the shareholders. So they still need a way to prevent this happening. One of the things that you'll talk about in F8 and P1 particularly is how do we prevent there from being problems. It's not what do we do once we've found them. It's all about how do we stop them from being problems in the first place. So cash is always a very big area because it's always very tempting for employees to try and take it. And in effect, as I say, we have to try and stop them from doing it. The final bit we've got there in this little section on financial systems talks about working capital. And when we're talking about working capital, we've got inventory, we've got receivables, we've got cash, we've got payables. Basically, your current assets and your current liabilities. All we're thinking about there is how do we make sure that we don't have too few of them, and how do we make sure we don't have too much of them. You don't want to have too little inventory. If you have too little inventory, it means that you might run out. You may well have come across something called a stock out. So one of the things that you do in F2 is you talk about how should we order our stock, our inventory, to make sure we don't have too much and we don't have too little. If we have too little, we run out and we can't make anything. If we have too much, it's sitting in the warehouse, we've already paid for it, and it's not earning us any money. So we've paid for something that actually we don't need. So the idea is with all of those, not too little and not too much. That's a very big issue, particularly when you get up to papers like F9, when you start doing more financial management. That's going to become a big deal. So as far as the accounts department is concerned, there are a number of different things that we need to think about as far as the systems are concerned. Now, these systems could be debits and credits, recording things, but the systems could also be who's allowed to buy it, get a bit of paper from them. Who's allowed to phone up a debtor, get a bit of paper to record what they've done. Now, all of these systems, whether it's debits and credits or whether it's who's going to order them, what orders have been dispatched, what orders have been received, could be computerised as well as being done manually. Now, to be honest with you, I have my own small company, not that it does very much, and I basically use a manual system because I have like 2 invoices a year. It's not exactly big, my company. It's not worth me having a computer system. But for large organisations, it would be worth them doing all this on a computer, keeping a record of how much money we are owed by people, how much money we owe to people, what orders have we received that we haven't yet sent out, what orders have we sent out that we haven't yet invoiced, and so on. Because obviously it then makes it very, very easy for the managers of the company to look and see what's happening. Otherwise, they've got to go through loads and loads and loads of pieces of paper. When you're doing F3, you do everything manually. I'm sure you can imagine how much easier it would be if you had a computer to do everything on. So the advantages of having a computer system is it's faster, fairly obviously. It can do complicated things. You can have a look at all the money that is owed to you by customers whose names begin with the letter E who ordered things over $10,000 in December. You can do that if you want to. I don't know why you'd want to, but you could do. Whereas if you're doing it by hand, that would be a real pain. It'd be really difficult to try and do. Hopefully it will eliminate human error. It won't stop you putting things in the wrong accounts. So if you put your debit in the wrong place, the computer will quite happily put the debit in the wrong place. But what it will stop you doing is putting $90 in one account and $60 in a different account so that the double entry doesn't balance. It will stop you doing things like that. It will allow you to analyse things a lot, as I've just said. Now, disadvantages then, you've got to pay for all this equipment, you've got to pay for all the computer software, you've got to train people in order to use it. Different software packages work in different ways, and it may well be that if you're used to one of them, it still takes a while to get used to another one. Corruption basically means the files get corrupted, so they get damaged. Imagine that you've got all of your records in one place, and the computer hard drive gets damaged, and now you've lost everything. So one of the things that is a very fundamental thing is if you're going to put your accounts on a spreadsheet or on a computer system, then keep backing it up, make copies of it just in case. All of those things we've looked at so far are all about the work that the accounts department does and why it is doing it. The next little part of this chapter is going to talk about how they deal with other parts of the organisation.